Welcome to a weekly look at gold market fundamentals with David Jensen. Welcome, David. It's good to have you with me again.
Good morning, Jay.
We've been getting a lot of play, a lot of interest in this little discussion that we have almost every week. And there was a missive, actually an email that came through from a person named Brad in Warsaw, Indiana. He says he's really gotten hooked on these podcasts. He says he really enjoys our discussions. He likes John Rubino and Daniel McAdams as well. But he also commented. He said it's really been very helpful to him in understanding what's going on in the gold markets. He said he has really gained a lot of understanding. But if we could perhaps provide a little more detail and some definitions, it might clarify it even more. But he's very grateful for what we're doing, David, and for your efforts in putting together these thoughts every week. So I thought maybe we'd start out this week by asking you to perhaps clarify some definitions. Now, they may seem very elementary to many of our listeners, but to those that aren't quite clear on it, it might be very helpful in clarifying what's really going on in the gold markets even more for more people. So I'd like to start out with some of these basic definitions, David. First, spot.
Yes, spot is a contract which trades metal and gives immediate ownership to the contract holder. So when you're buying spot, you're notionally buying the metal itself for immediate ownership.
Okay, and what about forwards?
Forwards are, the price of a forward is set based on spot plus some cost for future delivery of metal. And again, it's a contract for metal delivery, giving you ownership at a date certain in the future.
And what about the term futures then? What's the difference between forwards and futures?
Yeah, futures are because they aren't exercised each time for delivery, and really they seldom are. I really look at a futures price as a bet on where the price will be in the future. Mm-hmm. But the price is set on the spot market, on the daily trading market, and so the a futures contract is a bet on where the spot price will be in the future. But again, I don't look at gaming the futures market as really impacting the spot price because you don't have exercise for delivery of the metal on a typical occasion.
You don't have the right then to take delivery, is what you're saying.
Well, you do have it depends on how the contract is written and what your exchange is, but typically they're just settled for cash.
Okay, open interest.
Open interest, it's the total ounces of gold for which there are trading positions or claims of metal in the market. So you may, we refer to hundreds of millions of ounces of open interest, mm-hmm. And what that means is that there are contracts both in forward and your spot contract position summing up to that amount.
Okay, and then net settled clearing volume.
Yeah, this is a really kind of an obscure term which the LBMA has introduced, but you have these members trading between each other, and they all trade back and forth between each other on a daily basis. And the London bullion market posts on a monthly basis the average daily net settled clearing volume, and that number reflects the net amount of trading between the different members. So let's say you take two parties, and let's say I sell you 10 contracts but buy one contract from you, then the net settled volume would be really the 10 minus 9 or 1 contract. Mm-hmm. But when the LBMA posts these volumes, it really strips away the detail that you need to know to understand the real, what we call the turnover or the trading volume, which would reflect the total flow of ounces. The 10 ounces in one direction and the 9 in the other, there's mm-hmm. 19 ounces. Mm-hmm. So, the trading was really between the two parties there was 19 ounces and not 1 ounce.
Mm-hmm. So then in this hypothetical example you just gave of the 10 contracts, 9 of them just disappear?
18 of them ultimately disappear.
18 of them, because in both directions.
the net settled clearing volume, then I sold you 10 and I bought 9 from you. I can't remember if it was the other way around, but either way, you say, well, the net amount between you is 1.
Right.
Right, so it hides the real volume when you deal with it on that basis. It's really a distraction. So I want to be clear on that. The net settled end of day net settled clearing volume is really the debits and the credits between the various houses. But what we really want for a sense of flow of volume of trading is just the gross trading volume. Which the LBMA has provided in that local London liquidity survey from Q1 2011 that they published on their site.
Right. So let's get into that a little bit now, and if you would care to go ahead, David, with that.
Yeah, sure. In Q1 2011, the average turnover of gold, they said in that report, was 174 million ounces a day. These are really the highlights of that report, because we have a limited amount of time.
Sure.
But they were ultimately the average, the turnover of gold was 174 million ounces of gold a day. The trades averaged about 39 million ounces of gold per trade. Mm-hmm. And as we've referred to in the past, that there was a 10-to-1 ratio of the gross trading volume, or the turnover, versus the net settled end-of-day cleared trading statistics that they post. Mm-hmm. So, and they do note that this 10-to-1 ratio was conservative, that the trading volumes were actually higher than they put in their liquidity survey. Mm-hmm. And then the other salient note I think came out of it was that 90% of trading volume on the LBMA was in the spot gold market. So it's that I own this ounce now. I have a contract for ownership of gold, mm-hmm. With my agent, and that the gold forwards were only 5% of trading. So, to sum it all up, there's really I think 4 key items from the LBMA survey. Well, one was that their trading volume that they estimated was conservative, and that it's actually higher than listed in the study in their the local London liquidity survey. Mm-hmm. The 10-to-1 ratio, which we referred to in weeks past, is a key item to calculate the gross turnover, or the daily trading volume, gross trading volume versus the net settled. Keep in mind that again, that 90% of daily gold trading was in the spot contract basis,
right.
And only 10% were in other instruments. So they're clearly setting the price of gold there in London with that level of volume and that percentage in the spot market. And then that just a note here on that, the trades averaging $39 million a trade. You can see there that you have these. I think it was around 6,000 trades per day that they were averaging, but you have these very, very large trades coming through. And they're really, locomotives going back and forth through the market. And for proper price discovery, you like to see, a higher volume and a lower dollar amount in terms of being able to determine the correct price. Mm-hmm. When you have these enormous dollar amounts going through and relatively few of them, nothing can really move the needle in the market, as it were, other than these trading positions mm-hmm. that are going back and forth between these major banks that are members there in London on the LBMA.
Right. Well, David, as I look at watch a lot of times during the day when I'm sitting at my desk, I look at the Kitco spot price. I guess that's a spot price for gold, and it's not uncommon that around 10 o'clock or so U.S. time you'll see just a precipitous drop. It just happens within a couple of minutes. You'll see a $10, $15, $20 plummet in the mm-hmm. price. Is that because you're seeing probably some of these big 39 million trades coming through that are hammering the market?
That I can't really give you a specific answer. I mean, it's difficult to say at that time whether you're dealing with COMEX volume or the London volume. Mm-hmm. Here on the West Coast, London currently closes at 8 a.m. in the morning. Yeah. And I've actually seen recently been seeing run-ups as they approach the close there. Yeah. And I think that there's a sub-rosa movement afoot to try to get physical out of the market, and I think mm-hmm. that's what's causing these occasional run-ups into the close. Is mm-hmm. that there's a scramble on, and I think it's because of the problems of the structure of the market, and maybe we can go on to talk about that, the market structure itself.
All right, David, you talk about a guide to London precious metals markets. Could you talk to us a little bit about that? What are you talking about there?
Yeah, that's a report that was put out in 2008, and it's posted actually on the London Platinum and Palladium Market website. And what it does is really give a description of the trading that goes on. It goes into an awful lot of detail in terms of technical aspects of the trades. So I've tried to select out the keys to it. There were some other elements there that we could touch base on the structure afterwards. But the key items from that report were really that they noted that the majority of the trading in London in the gold market is in unallocated accounts.
Mm-hmm.
And they say very clearly there that in these accounts that the client purchasing metal does not have title to any specific metal and is a, quote, an unsecured creditor, unquote.
Wow.
And so what you're dealing with then is you're dealing with an agent who enters the market and says they're holding a position for you, but there's no real metal that's allocated to you. And so when you enter this spot market, you really end up with credits or debits to an account, as they note as well.
Mm-hmm.
So the fact that you're not entitled to any specific gold or silver really means that they can create gold without limit and silver without limit in these accounts for you. And so they have an expandable repository in which they can bring in these very large funds, industrial interests, sovereign wealth funds who say, well, I want gold. I want to enter, buy some gold for me in London. They say, okay, well, we're holding gold for you in London. But what they're really holding is a paper claim. And what you are really is you're an unsecured gold or silver creditor. And so, what's happened here is that with time and with the creation of these virtual instruments that are trading in London through these unallocated accounts, is that they've really converted a trade in the physical metals of gold, silver, platinum, and palladium into a virtual market and virtual pricing structure.
Mm-hmm.
So, and this, I referred to this last week as dream gold, and it's kind of a, maybe it's a unflattering portrayal of what's going on, but it really is dream gold in terms of that it's a virtualized creation of gold and silver which can be created without limit. And the reason this is important, as they note in this LBMA report, they say that virtually all transactions in gold, silver, platinum, and palladium are set on the basis of what they call the Loco London, or the London pricing structure.
Yeah.
So they are setting the global price for these four precious metals in London with these virtualized accounts, which are trading on what should be a gold and silver exchange, but is really a virtual exchange of claims on gold and silver.
So it really is a gold fix.
Yeah,
it's a rigging.
Yeah, it's a creation. It's just notional, and
it has nothing to do with the physical. Essentially, very little to do with it.
Yeah, it creates severe problems when you realize that as Larry Summers, Lawrence Summers' paper, he was a former Secretary of the Treasury. When you note the linkage between gold and interest rates, the historic linkage over hundreds and hundreds of years.
Yeah.
And notionally, that if you start to print too much money, your interest rate should surge,
right?
And your gold price should surge with it. And there was this, what they called in the 1990s. I remember reading Wall Street Journal articles in the late 90s and the early part of this century, referring to the Great Moderation and how incredible it was that inflation had gone away, gold is not rising, even though they're printing lots of money, and nothing went away. It was just covered over.
It was rigged, and so it's incredible. Yeah, Summers understood that that if you wanted to have a policy of low interest rates, you had to cap the gold price. So that explains it from a policy perspective. Why they're doing it, I suppose most people engaged in this grand scheme are not aware that it's going on. The traders and so forth, they're just looking for ways to make money. Yeah. But the stage is set by the higher up policymakers, apparently. With this structure.
Yeah, the LBMA says specifically that prices globally are set on the basis of their local London pricing. So, you rig the gold price, you don't just rig it in one place, you rig it globally. And that's the problem that we've gotten into now, is that this market, which has been looked to, by the miners, by the financial industry itself, and investors have concerns about what has now happened with this credit bubble that's been blown globally as a consequence of the rigging of this market. So
Absolutely.
this is the issue now, in that you have this system which is set in place, which has basically become a speculative merry-go-round based on really nothing in London.
Well, if they're looking to set it globally, then you have to wonder to what extent the Russians and the Chinese will be cooperative with that effort. That's a question in my mind, perhaps one for another discussion, David.
Well, I think they're pulling away, Jay. In short, we can see that they're pulling away. They're taking the metal out of the system, and I think that globally we have that artifact happening as well. That people have had enough of this and are starting to remove material from the system.
Yeah, maybe China and Russia, but I wonder about India, because they seem to be sort of sitting on the fence to a certain extent. At least that's my impression. The Indians seem to be influenced by our central bankers to a certain extent, I think, in terms of, trying to get them to play ball with our guys, I suppose. But in any event, you also in your notes to me today talked about the LBMA's silver problem. What do you mean by that?
Well, we digging into these numbers from the LBMA in terms of their clearing statistics, and also sussing out the turnover volume from the gold market. Now, they don't put out a specific report on the silver market itself, but I think it's safe to use the gold report for an estimate of the net settled versus the turnover volume. And looking to gold first, and November 2014 is the most recent statistics of trading. They were saying that they were trading about 21 million ounces a day net settled, which translates to 210 million ounces a day in gross turnover.
Mm-hmm.
Now, when we use it, they don't say what the open interest is, but we know from most commodity markets that you're looking at a 2 to 5 time turnover volume versus open interest, and as we said at the beginning, the open interest represents all the claims that are out there for ounces. So, looking at 210 roughly million ounces, you've got about 420 million ounces open interest of gold claims using a 2 times multiplier. And if we use a 3 time multiplier, we're looking at 630 million ounces.
Wow.
Now, it's a lot of gold.
Put that in perspective with how much is out there in the markets to be traded. How much physical is there, and how much is produced every year, David?
Yeah, well, the dominant physical gold stockpiles, of fungible metal. If we use the central bank holdings of gold, they're holding about 1.2 billion ounces of gold according to their books.
Mm-hmm.
So the open interest there is representing a third to a half of the global of the large global refined metal stockpiles. Now, there have been 5 billion ounces mined throughout history, but what we're concerned about is metal that's available quickly to market.
Mm-hmm.
So that there is the least supply from the central banks of 1.2 billion ounces, and there's also about 90 million ounces plus or minus of global mine production annually. Mm-hmm. So the open interest is representing there about 3.5 times to about 7 times. So 7 times the annual production of gold.
Wow.
But it's large. But I mean, there are large stockpiles of gold that are out there. But silver is a completely different story.
Yeah, silver is much more of a gap there. Yeah.
So if we look at the November 2014 numbers that were posted by the LBMA, we have about 172 million ounces, net settled clearing daily in November, and we use the 10 to 1 gold multiplier. It gives us about 1.7 billion ounces.
Billion ounces, right?
Yeah, of gold that's turned over or traded daily. Now, when we look at the open interest based on that trading volume, we use the 2 time multiplier again. it would give us a 3.4 billion ounce open interest, and a 3-time multiplier, as we touched on last week, would give us about 5.1 billion ounces of open interest. Now, interesting, big numbers, or billions, and it sounds like a lot, but I think what really draws it into relief is looking at the CPM group and the Silver Institute estimate of the above ground stockpiles of 0.9 billion ounces.
Mm-hmm.
And then also the annual mine supply of 0.8 billion ounces. I mean, you've got claims there that run 3.5, 4, 5 times what can possibly be brought to market quickly in terms of settling out these positions.
Mm-hmm.
And that's if all of it was all of a sudden withdrawn from these ETFs, which are included in that 900 million ounce or 0.9 billion ounce stockpile. So, what we see here is the consequence of trading credits to an account and not the metal itself.
Yeah.
And yeah, sure, there is a lot of silver jewelry in private hands above ground, but that's not available in the short term. You need much higher prices to be able to take it out of people's hands, and it has to be enough that it impacts the sentimental value of the jewelry itself. So, we're just seeing here a setup here where we've got claims on silver which vastly outstrip what could possibly be brought to market in terms of settling this out. And really what we have set up is a short squeeze, and someone is going to start pulling this physical metal out of the market and impact this open interest here and impact the available silver to market. And I really don't think this can go on very long. I know things have gone on a lot longer than we've thought it would. But when we look at these imbalances here, we've got a setup here where things can go wrong very, very quickly.
Well, that's for sure. And again, just to highlight those numbers, you're looking at, for silver, above ground, readily available 0.9 billion ounces compared to 3.4 or 5.1 billion ounces of trade a day, a paper trade a day, and then annual production 0.8 million ounces. I know that'd be billion.
Billion, yeah.
Billion ounces, right. So it just shows how much, how ridiculous these numbers are. And what it seems to me, David, is in the minds of most traders, they're thinking to themselves when they enter these contracts, I'm actually trading gold. I'm actually trading silver. And they think, and they don't really want to take possession. I don't blame them. Where are you going to stockpile, especially silver? Where are you going to put it? But the point is, when problems really start to arise, as they started to in 2008, 2009, we're looking at an equity market that's looking ever more vulnerable in many ways. We'll be talking to Dr. Robert McHugh, who's suggesting that we're approaching the jaws of death, a market formation that tells him that we're in some very dire straits, not too far into the future. Well, when people start losing confidence in the paper monetary system, the one that's based on enormous amounts of leverage, more than any time in the history of humankind probably, then when the system starts to go into reverse, people want to find the real thing. They want to have a monetary metal. They want to have some monetary unit that they know will hold its value and they can use for life-sustaining purposes, right?
Yeah. It's been going on for decades, Jay. It's not a recent phenomenon. And this is the problem. As soon as they went to unallocated gold and unallocated silver, it created a system which was really, you could look at it like bellows. You could increase them or you can decrease them at will. And we're not talking about futures here. We're talking about forwards, and we're talking about open interest in the spot market. But entities who believed in the market would enter this market and could get positions, and you could just expand it or contract it and give the appearance that you're actually dealing in metal. And when you occasionally have people withdrawing metal from the market, you could meet that demand as long as the vast majority said, oh, well, I've got a position, we've got a position with XYZ bank in London, and absolutely we're sitting in gold. And no, you're not sitting in gold. And this is the realization that we're coming to now. And maybe we can touch next week on the structure of forwards and forward trading, but you can create such a rat's nest of rehypothecation I mean, the London report there on the structure of the Guide to London Precious Metals Market, it talks about hiccups in delivery and why it occurs because you've got to bring the gold in from Switzerland, and I don't think that's really the issue. Is when people actually call for delivery of physical, they're impacting this rat's nest of interdependent and rehypothecated claims, and it just quickly results in a traffic snarl. And I think that's what we're headed for here is that, especially with this silver market, that the silver is not there, and it's just a virtual structure that really is not based on reality at all.
Yeah, David, I just sort of a humorous thing that came through over my desk from the Gold Antitrust Action Committee. There's this fella from the Perth Mint that's suggesting that the gold price is as low as it is because of marginal gold producers. There's too many companies that shouldn't be producing gold that are still producing it, and all that awesome physical amount of gold that's hitting the market is driving it lower. But this is part of the propaganda that's being used out there to keep people thinking that there's no gold shortage, that everybody has a claim to the gold they think they have a claim to.
Yeah, it's when you look at this structure here in these markets and you realize these virtualized physical quote-unquote positions, which aren't physical, they're virtual. And what he needs to, is that Bron Szejcki? I don't know who that is from.
Yeah, that's who it is, yeah. Mm-hmm.
Yeah, but I mean, he needs to take into account these open interests here of, if he wants to say that about gold and that there's all these positions available from central bank lease gold, that's fine. He can say that. Even though it's pretty clear that it's not true with these open interests. But the one that I think you really can't challenge is these enormous open interests in silver sitting on the LBMA, and where is this metal and where is it coming from? And it's this. I've gotten into discussions and arguments with other people about the forward market doesn't matter and the spot market is where it's at, and all these arguments are really sub details. The issue here is that you're not trading the metal itself, and you do not have a claim to a specific bar in London as you do in what I consider a real gold exchange, which is the Shanghai Gold Exchange. To sell a kilo contract, you've first got to deposit a kilo bar, and your contract is a claim on that bar. That's a real gold market.
That's a real gold trade as opposed to the fantasy gold trades. But in order to keep this paper game going, the propaganda must be put out there to make people believe and have confidence in the system. But this guy, Szejcki, says, quote, we need a much, much lower price of gold to really kill this potential supply, meaning supply coming from the marginal miners. But this hasn't happened. We haven't seen large numbers of bankruptcy or care and maintenance mothballing occurring yet. So, this is just part of the propaganda, I believe. It's just, as you point out, because of this massive number of paper contracts that come onto the markets that really force the perceived price of gold down dramatically. And of course, that's all part of the same game of keeping people in the paper game so that those that control the paper game can reallocate wealth from the pockets of those that produce it into their own pockets. I'm afraid that's what's going on. David, anything else to add this week yet?
Yeah, I just these open interests really represent a massive vacuum of gold and silver, and when these repositories crack, they're going to suck all of the oxygen out of the room in these markets, and these markets will crack because of the visibility that is out there, and seeing that gold has been trading up with the U.S. dollar and silver as well, for that matter, it means that gold and silver are outperforming the U.S. dollar, even as the U.S. dollar has been outperforming all the currencies. We see them starting to assert themselves as the premier currencies that Greenspan referred to. But I just think it's crucial for people to understand the structure of these markets, analyze these London markets, reports from the London market, the LBMA, and then ask the tough questions. And they just say, well, where's this 3 to 5 billion ounces of silver going to come from when we've got global stockpiles of refined metal, including all of the ETFs under 1 billion ounces, 0.9 billion ounces, and all that silver from the ETFs. You're not going to get it all out of those if you want to try to deliver it. So there's gaps there, and there are gaps, there are questions that need to be asked, and we've had this virtualized creation of these international debt markets and a disconnect of physical assets from reality. And I think that what we're going to see now is a reassertion of reality in these distorted markets. And I think that ultimately that you're going to see the markets rapidly move away from London and New York because of the breach of trust, which I see has happened here. In my view, that's what's happened, and there will be hearings on this, and we'll let them speak to what is really going on. But it does not look good to me and healthy for our society as to what has gone on there and the distortions that we're seeing today.
Well, it certainly doesn't, David. And when that oxygen is sucked out of the room, we're not going to be given a lot of advance notice. And I think what's very interesting, as you point out, that gold has been rising even more than the dollar since about middle of December or so, and the dollar's rising against all the other currencies, which suggests to me that on the margin there are some increasing numbers of smart thinkers, people that really understand how the markets work and are not indoctrinated by the propaganda, that are saying, wait a minute, I think we better buy some gold and we better trade some of our paper in for gold. And so I think that the message that I would like to leave with our listeners is that now is the time to take physical if you haven't done so, because you're not going to necessarily have a lot of advance notice to do that. And we're sitting still at a very low price for gold, I think, and silver, even more so for silver, David. I would imagine maybe perhaps you can make the case that silver has a bigger upside run than gold.
Yeah, I think that market looks like it's heading for a lockup, and that you're going to see an enormous reset in price. And I don't think it'll be an orderly a trading that you're going to see. You're just going to see a reset in the price, and I think it's we'll see what happens. But it's just I can't comprehend how you're going to deal with these open interests and these claims of silver, plus all the other demands on the side from investors, as well as the imbalance that's sitting in the London market. So we'll see where it goes, but it doesn't look healthy, and it doesn't look good.
It doesn't look healthy and it doesn't look good. We'll have to leave it go at that for this week, David. Thank you very much again for sharing your insights with our listeners. I think it's very, very important that people pay attention to what's going on. The markets look increasingly shaky, and so don't waste any time. Make sure that you own some of the time-tested money, gold and silver, for thousands of years. It's held up as money, as reliable money, when all the other currencies have really self-destructed. Thank you very much, David. We'll look to do it again next week.
Thank you, Jay.